Welcome back to Global Lens. The global economy is on tenterhooks over U.S. President Donald Trump and his tariff policies. The delays and reversals in the imposition of tariffs does offer a temporary relief to America's trading partners, but the uncertainty around it is weighing on economies and companies worldwide, with billions at stake. Most of its trading partners are racing to the White House to strike a deal. Trump administration has set 1st August as the deadline. Now, as per JP Morgan, while the larger impact of the U.S. trade war will be felt by the United States, rest of the world will not be insulated. JP Morgan says Trump's tariff could reduce the global GDP by 1%. Joining us to take this discussion forward is Alex Muscatelli, Director, Economics Group, Fitch Ratings. Alex, thank you very much for joining us. How do you think Trump's tariff strategy is going to impact the U.S. economic growth this fiscal?
Thank you. Thank you for the invitation. Well, we just published our global economic outlook for June, and there I think we have two key messages. Is that on one hand, the de-escalation in trade tensions that you talked about since the April hikes and the sharp rise in tariffs that we saw in April. And especially with the de-escalation between the US and China has brought about in our forecasts in an upward revision compared to April, compared to the global economic outlook that we published just before the middle of April. And there we were thinking that the global economy would grow at a growth rate of less than 2%. This year, and so which is really a historical low, lowest probably since the global financial crisis. But in the June global economic outlook, in our latest forecast, we have revised up that growth rate. We revised it up by 0.3 percentage point to 2.2% for this year and 2.2% for next year. So, and the environment that we're looking at is one that you have described, that is a de-escalation compared to April, but at the same time, a sharp slowdown in the pace of a global economic activity compared to last year. And this sharp slowdown is in large part due to U.S. tariffs and to the increase in U.S. tariffs.
Right. I would also like to ask you about how do you factor in the US-Canada trade war that we are now seeing? And US has now also imposed tariffs on almost 25 other nations. On countries like Brazil, he has imposed a tariff of 50%. Canada, he is threatening to impose a tariff of 35%. How would you factor this in your analysis?
Right. I can tell you how we factored in for our published forecast. And essentially, what we are assuming now is an environment of tariffs quite similar to the ones that we had back in March. And so overall, we are looking at an effective tariff rate for the US, that is the average tariff across all goods in all countries of around 17%. And this breaks down into a tariff rate of around 40% on China, 15% on the EU, 15% on the rest of the world, and lower rates for Canada and Mexico. Now, the tariff rates that you were just talking about, yes, they have been advertised by President Trump. They could come into place for some sectors of the economy, some parts of the economy. There is some scope for countries to negotiate and negotiate down these headline tariff rates. So for the moment, we are assuming an overall tariff rate of, on average, around 17-18%. What this does, what the impact it does, and this is based on our model-based estimates on that we've done in the past few months. They're not that different to the ones you mentioned earlier, and we think that tariff rate on average of the ones like the one I just described would be consistent with the level of GDP in the world economy to be around 1% lower than it would be otherwise in a context of no protectionism.
Right. That's why do you feel that stock markets around the world, while they will be impacted by these tariffs, they will be able to absorb the sentiment and move on, considering not much has changed since March this year, and a lot of this is being negotiated and reversed. So do you think the stock markets will be able to brush off these tariff threats?
Well, we don't really we don't forecast share levels or share prices, and on average, you would expect that over periods of time, share prices tend to go up over time in a sort of normal circumstances. However, I think the precedent that we saw in April and May is quite important. That is, we had a lot of financial market volatility after the announcements on April the 2nd, and that brought about a moderation, a pullback, a rolling back from the US, more time dedicated to negotiations. So I think that the stock markets are thinking that this will be a repeat of April and May. That is, very, very bellicose pronouncements, followed by lower actual tariff rates.
Right. Would there be certain sectors which you expect to be impacted more than others?
Well, of course, we are already seeing this, right? We're already seeing this in aluminium, in steel, in auto, in pharma, and potentially in pharma, not yet, but potentially also in pharma. We had some announcements on copper. Now, I think what will happen is that specific countries whose exports, or specific trading areas whose exports are heavily reliant on some of those sectors, will try to negotiate carve-outs. We've seen that although for Canada and Mexico we've had strong rises in tariffs, we've also had exemptions for imports under the USMCA trade agreement. So the combination of sectoral, I would say that the combination of sectoral tariffs and headline tariffs can be confusing, but it could be a way for the US to introduce more restrictive measures going forward. We shall have to see.
Right. I would also like to ask you about India. How do you think India is going to be faring in these trade wars, and also as a result of US-China tensions?
Well, I think we've got a bit of a mix here, because on one hand, the fact that we haven't had an announcement on a trade agreement between India and the US yet, I think points in the direction of a challenging negotiation, and some important points of disagreement that would need to be addressed to get an agreement. At the same time, India could be placed as a beneficiary of heightened trade barriers and heightened trade restrictions between the US and China. India could be one of the countries, along with the countries in Southeast Asia, that could benefit from trade diversion. Overall, given the makeup of the Indian economy, given the size of the domestic economy in India, external factors and rising US protectionism would not have such a big impact as it would have in other countries, which are more open and more exposed. So what we are looking at for India, following a strong performance in the last quarter of financial year 24-25, we're looking at a relatively stable pattern of growth of 6.5% of GDP growth for financial year 26, 6.3% for financial year 27. And this is in the context of inflation staying quite low and the RBI having cut rates, cutting also liquidity reserve requirements to enhance liquidity. There is the scope through looser financial conditions for domestic demand, especially capital spending, to pick up. And we do see domestic demand as the main driver of growth in India over the years ahead.
All right. Alex, thank you so much for joining us on the program, giving us your overview on how this trade war will impact global growth and how does India stand to benefit or lose as a result of these geopolitical tensions. Thank you once again for being here with a view on how Fitch Ratings sees the global situation.
Thank you and good evening.
Let's move on. Here's